Thursday, January 26, 2017. Monaco 64, home of alternative economics and contrarian views. So it's about quarter to 6 p.m. London time. Markets fairly steady today. Dow well above 20,000 now, up 23 points at 20,088. The high today has been above 20,100. I think that was earlier before the open on the futures. I'm not too sure. But anyway, there are some viewers who think I've been calling for the Dow to crash. Basically, I haven't really. Maybe I have said in the past that I expected a correction. But for the last few months, I've just been following things and, maybe looking for the Dow not to break 20,000 and maybe drop from there. But right now it's above that level. Of course, I have spoken about the WebBot and Cliff High's prediction or forecast from years ago that the Dow would reach 20,000 and then turn around and silver would go up, astronomically. But that's just me reporting on the WebBot and Cliff High. It doesn't mean to say I believe that. It's possible. There's a few analysts and investors who I respect out there who are actually fairly bearish in the stock market. The first one is Charles Nenner of Nenner Research, and he does cycles work, and he expects the stock market to start going down this fall. So there's still a few months, 9 months to go there. And but he had a target of 2282 in the S&P. I guess that target's been hit. The other guy that's bearish, the other day I heard, is Mark Faber of the Gloom Boom Doom report, a Swiss investor based in Thailand, and he's got good reputation. He's very bullish precious metals and the mining shares. So I'm not saying that I'm bullish anything or bearish anything at the moment. Just noting what these people are. Personally, I think as a trader, yeah, you can't fight the tape. We've broken through 20,000 in Dow. You might want to go long a little bit. I'm not saying as an investor you should be in the Dow. I've looked at some of the components of the Dow today, some dividend yielding stocks like Procter & Gamble. And then I looked at the chart, long-term chart, and it just feels difficult to put some money to work at these very, very elevated values or levels. As a value investor, I think this is not a good time. Plus, also as a fixed income investor, it's also not a good time. So tough for investors. I think the only kind of people who do well in this environment of very low interest rates and low volatility are speculators who, they go for special situations, and they can make quite a bit of money, and they use leverage, but not everyone can do that. So yeah, I think the in general, savers, pensioners are still being punished with these very low interest rates, and it's going to continue, unfortunately, unless something occurs. So the other thing I wanted to talk about is the bond market today, because that's starting to get a little more interesting, especially in Europe and with Italy. Today, the 10-year BTP, Italian government bond, was up 12 basis points at 222. Remember in December, right after the referendum in Italy, we are hovering around 2%, even dropped below 2%. So now, in the last month, the Italian 10-year yield is up 41 basis points at 222. So we need to keep an eye on that. Italy, and their banks. Portugal up 13 basis points. It's up 36 basis points. in the last month at 4.07. Spain doing relatively well considered. Sometimes it's associated with Italy. It's only up 3 basis points. The Spanish Bono or 10-year at 155. It's up 20 basis points the last month. UK gilt up 4 basis points at 151, fairly steady. But treasuries, yeah, the 10-year yield is back above 2.5% after dropping below 2.4 in the last few weeks. It's now 253. 264 is still the key level. And yeah, that's in the bond market. Gold, of course, today has been hit hard. We got down to 1184. I'm not concerned as, you know, what's the point of leaving money in paper money in the bank if you get no interest? So I'd rather have this in my hand or a little bit of this as well. You know, no point. But of course, you do have to hold some paper money in order to transact the economy. As a saver, yeah, I favor gold, physical gold and silver. Doesn't mean to say that I do not participate in the market, you know, speculate here and there. And what else? Yeah, so gold right now, 1187, silver 1678, both down just over 1%. Year to date, gold up 3.3% in US dollars. In pounds up 1.5%. So the pound is kind of, is outperforming the dollar this year so far. I think mainly to do with these shenanigans concerning Brexit and, you know, volatility. I still think the pound is, well, all fiat currencies are sinking. Some are sinking faster than others. Some come up for air, you know, a little bit. But at the end of the day, they're all sinking against real things, you know, that you can hold in your hands. You know, minerals, housing, land, all of that. And the other thing I wanted to talk about, more to do with geopolitics and politics. I was thinking, you know, because of the Trump presidency, you know, the big division that there is, you know, you saw those protests right after Trump took over, the women protests, whatever it was called. You know, I saw that Madeleine Albright, former Secretary of State, saying, I'm ready to register as a Muslim in solidarity. There's so much division, you know, it looks like, you know, the U.S. and the world, you know, is so divided. And it's almost as if the powers that be are doing this on purpose because, you know, there's that old saying of divide and conquer. You know, if everything in the world is running smoothly, there's no wars, there's prosperity, people are free, there's little poverty. What's there for the politicians and the do-gooders to do? Not much. So, yeah, it's almost like, you know, we had this 8 years of the first black president or African American, liberal, you know, socialist leaning president that pleased a lot of people in the US, you know, and then, you know, pissed off a lot of the white conservative American. And then now you have someone completely the other way. It's almost as if, you know, the powers that be are trying to pit everyone against each other so they can do things so the public can have a lot of distractions because the world is still a lot worse off than we were in 2008 after the crisis. We have even more debt. We have a huge amount of nominal derivative, OTC derivatives exposure. The only reason U.S. banks are not bankrupt is that they've been allowed to, change the accounting mark to model instead of mark to market. Same thing in Europe. So that's what it feels like. For the average person, I don't know people's circumstances, but for me, I think just keeping your feet on the ground in reality and trying to avoid basically listening to the news, be it mainstream media, sometimes also, alternative media can be very difficult, but you need to keep it real, I think, and just follow the money and see what's really happening, and not try to get involved with all the division, and just keep your head down, and do what you think is right, and do not try to follow the crowd, I guess. So that's it for now. I hope you enjoyed this video. If you have, please give me a thumbs up. If you haven't subscribed to my channel yet, please do. And share this video, far and wide if you'd like to, with friends, families, and colleagues. I'll talk to you later. Take care. Bye.